Hey everyone, welcome back to the channel. Today, we're diving into a topic that's got Wall Street buzzing and frankly, a little nervous. Are we on the brink of a major stock market correction? That's the question many are asking, and legendary investor Jeremy Grantham is answering with a resounding yes. But is he just another doomsayer, or is there real substance to his warnings? We're going to break down his arguments, analyze the data, and give you actionable steps to protect your investments. Buckle up, because this could get bumpy. Now, who is Jeremy Grantham? For those unfamiliar, he's the co-founder of GMO, a hugely successful investment firm. He's known for spotting bubbles long before they burst. Think the dot-com crash and the 2008 financial crisis. He's not just throwing darts. He's got a track record that demands attention. So, when Grantham speaks, people listen, or at least, they should. He's been sounding the alarm about a super bubble in the U.S. stock market for quite some time, and he believes we're now entering its final act. A final act that he believes will end in a painful meltdown. According to recent reports on MarketWatch, Grantham is doubling down on his bearish outlook. He points to several key indicators that suggest the market is overvalued and detached from economic reality. He's not just making vague predictions. He's laying out specific reasons why he believes a crash is inevitable. One of the primary concerns he highlights is the excessive speculation surrounding artificial intelligence. He sees the AI hype as a bubble within a bubble, inflating stock prices to unsustainable levels. He argues that the market is behaving irrationally, driven by FOMO, fear of missing out, rather than sound investment principles. Let's unpack this AI bubble argument a bit further. Grantham believes that while AI is undoubtedly a transformative technology, the market is vastly overestimating its near-term impact on corporate earnings. He draws parallels to the dot-com era, where the internet was also a revolutionary technology, but many internet companies ultimately failed to deliver on their lofty promises. He's not saying AI is a hoax. He's saying the market is pricing in unrealistic expectations. This reminds me of the concept of technological diffusion, where the adoption of a new technology often follows an S-curve. We're likely in the early stages of that curve, and the exponential growth priced into many AI stocks is simply not sustainable. Furthermore, research by economist Carlota Perez suggests that technological revolutions are often followed by periods of financial turmoil as speculative bubbles burst. Beyond AI, Grantham points to broader market overvaluation as a major red flag. He uses metrics like the Shiller P/E ratio, which compares stock prices to average inflation-adjusted earnings from the previous 10 years, to demonstrate that the market is trading at historically high levels. These levels have only been seen a few times in history, and each time, they were followed by significant market corrections. Imagine a rubber band stretched to its absolute limit. It can only stretch so far before it snaps back with tremendous force. Grantham believes the market is that rubber band, and the snap is coming. Grantham's firm, GMO, has also published research supporting his views. Their asset allocation forecasts suggest that U.S. equities are poised for significant underperformance over the next several years. They are recommending that investors diversify their portfolios and reduce their exposure to U.S. stocks. Now, it's important to remember that GMO has a vested interest in these predictions. They manage money, and they're trying to sell their investment strategies. However, their research is based on rigorous analysis and a long-term track record of success. We need to consider the source, but we can't dismiss their warnings out of hand. Of course, not everyone agrees with Grantham's pessimistic outlook. Many market bulls argue that the U.S. economy is resilient and that corporate earnings are strong enough to justify current valuations. They point to factors like low unemployment and continued consumer spending as evidence that the market can continue to climb. They might also argue that AI is different from previous technological bubbles because it has the potential to fundamentally transform the global economy. They believe that the long-term benefits of AI will outweigh any short-term speculative excesses. This is a classic debate between value investors like Grantham and growth investors who are willing to pay a premium for companies with high growth potential. Another counterargument revolves around the idea that traditional economic indicators are no longer reliable in a world of unprecedented government intervention and technological disruption. Some economists argue that the Federal Reserve's monetary policies have distorted market signals and that traditional valuation metrics are no longer relevant. They might also point to the rise of passive investing, which they believe has created a self-fulfilling prophecy, driving stock prices higher regardless of underlying fundamentals. This is a valid point, and it's important to consider the limitations of any single economic indicator or valuation metric. So, what is Grantham doing with his own money? According to reports, He's been reducing his exposure to U.S. stocks and increasing his investments in other asset classes, such as emerging market equities and resource stocks. He believes that these assets are undervalued and offer better long-term returns. He's also been investing in companies that are focused on addressing environmental challenges, reflecting his long-standing commitment to sustainability. This is a classic defensive strategy, shifting away from overvalued assets and into areas that offer better value and diversification. To understand Grantham's perspective, it's helpful to look back at previous market bubbles. The dot-com crash of 2000 and the financial crisis of 2008 both provide valuable lessons about the dangers of excessive speculation and unsustainable valuations. In both cases, the market ignored warning signs and continued to climb until it eventually collapsed. The common thread running through these bubbles is human psychology, the tendency to get caught up in the herd mentality and to overestimate the potential for future growth. As the saying goes, history doesn't repeat itself, but it often rhymes. Are we hearing those rhymes today? Beyond the immediate risks to the stock market, Grantham is also deeply concerned about the long-term sustainability of the global economy. He believes that resource depletion, climate change, and population growth are posing significant challenges to future prosperity. He argues that investors need to consider these factors when making long-term investment decisions. This is a broader perspective that goes beyond short-term market fluctuations and focuses on the fundamental drivers of long-term economic growth. It's a reminder that investing is not just about making money. It's also about creating a sustainable future. Okay, so what can you do to protect your portfolio in the face of a potential market downturn? First, it's important to assess your risk tolerance and investment time horizon. If you're a long-term investor, you may be able to weather a market correction without making any drastic changes. However, if you're close to retirement or have a low risk tolerance, you may want to consider reducing your exposure to stocks and increasing your allocation to more conservative assets, such as bonds or cash. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographic regions. This can help to reduce your overall portfolio risk. Consider rebalancing your portfolio. Over time, your asset allocation may drift away from your target levels. Rebalancing involves selling some of your winning investments and buying more of your losing investments to bring your portfolio back into alignment. This can help to ensure that you're not taking on too much risk. And finally, don't panic. Market corrections are a normal part of the investment cycle. Trying to time the market is a fool's errand. Instead, focus on building a well-diversified portfolio that is aligned with your long-term goals and risk tolerance. So what's the bottom line? Jeremy Grantham is warning us about a potential stock market meltdown, fueled by AI hype and unsustainable valuations. While not everyone agrees with his pessimistic outlook, his track record and rigorous analysis demand our attention. It's crucial to assess your risk tolerance, diversify your portfolio, and avoid making emotional decisions. The future is uncertain, but by taking proactive steps, you can protect your investments and navigate whatever challenges lie ahead. What do you think? Is Grantham right? Are we headed for a market crash? Let me know in the comments below. And don't forget to like and subscribe for more in-depth analysis of the financial markets. Thanks for watching.